everybody, and welcome to the Dash Trader Newsroom. Inflation briefly recedes as second quarter earnings begin. Here we are on July 11th, 2024. My name is Michael DeJoy, Director of Educational Services at Dash Trader, joined by my co-host, Jill Molandrino. Jill, how you doing?
Doing very well. Thank you so much.
Surviving this heat? We have quite a bit of a heat wave here in the Northeast.
It is actually pretty decent.
Good.
Yeah.
Yesterday was nice. We had a little breeze. I enjoy going out for walks. But we just got the CPI number out earlier today, and inflation recedes a tiny bit, 0.01% in June, or 0.1% in June, bringing us down to a year-over-year 3% inflation number, which is closer to the Fed's target rate of 2%. But the market made a new high and then rapidly reversed, and coming down off those highs pretty quick. Now, what are your thoughts on that? Is that just profit taking, or is there something more to this inflation number that we're not seeing on the surface?
You know what? I don't know, Mike. I feel as if, we're going into the July rate decision. I don't think there's anyone out there who's expecting to get a cut. I don't know if they're looking into it. It's so hard to read at this point, and I don't want to sound cynical and lazy about my answer, and maybe I'm trying to hedge here a bit, but it's almost as if the marketplace is fed up with the Fed's patience that it had when interest rates were lower and kept them so low for so long. And now they're keeping them higher for longer without really making a move or saying anything. So you have to question, is patience a virtue or is it not? Yeah. They're heavily relying on data. They haven't deviated from that, that trajectory. I think the only thing you could potentially extrapolate in terms of them shifting tact at this point is if the revisions in the employment data were pretty significant. So if we continue to get those types of revisions, what that signals is, in terms of the overall economy, jobs are one of their mandates, and we sit here and I know I sound frustrated, but it's like we sit and we look at this data all the time. And then, Mike, we talk about this ad nauseum on my desk, on your desk, on our shows, that for the everyday person looking at this data, it means nothing to them. So it's like, it comes back to that conversation about the bifurcated market and economy, right? Yeah. So, as someone who thinks about spending and runs a household, it doesn't feel like data is getting better sometimes.
Yeah. Well, I mean, the reason I included this snapshot of the CPI is that if you're, Main Street mom and pop America, right? Or anybody who's in the working class, a 20% increase on juices and beverages is going to hit you in the pocketbook way harder than anything else. So like the biggest number that stands out to me is that juices and beverages, right there on the slide, there is the top one, that increased by 20%. It's hot as heck in the Northeast. It's hot as heck pretty much across the country. And people are out spending 20% more. So that's going to, and then of course the next item is eggs, up 10%, right? That's month over month, right? I mean, that's a tremendous increase. So these are products that the working class feel much more than these other items, which have dropped in price, but you probably don't buy as much. Well, I have a friend who's a vegetarian, maybe a 10% increase in pork and meat and beef is not going to affect him, but 20% in beverages certainly will. So the actual pocketbook impact is that prices are still really increasing. Okay.
Yeah, well, Mike, what the challenge is when we look at this data and you see that, whether inflation data has come in a bit or year over year, using round numbers and hypothetically that it's, 0% flat on the year, only went up 1%, 2%. That doesn't matter. And again, we're talking about this, we're in an election year, right? So you're going to just constantly hear about it. It doesn't matter when things have been up from anywhere from 20 to 40% in just 4.5 years. Right.
Crazy,
and I don't, unless you're going from one job to the other, nobody got a 40% raise, depending, as an average middle class worker, right?
Yes, and they're saying that people are staying in their jobs more than ever, and that's actually, causing some other pressures on the economy because now people are
Right.
staying in their jobs.
I mean, it's like we sit there and we talk about, okay, what could put pressure on inflation, wage inflation, right? And again, it's our, these are the economists that debate this all day long, and it's our job to discuss it. But it's like, you know what? My salary went up 3% year over year.
Mhm.
Nobody wants to hear that on Main Street. I don't want to hear it, right? So,
No.
I mean, these things, I'm not a hedge fund CIO. So what I'm saying is I think I think that they either need to express the data in a different way, perhaps update their models, make it more digestible, because again, you're in an election year and this is what people hear, this is what they see, these are the headlines, and there's really no changing that.
Yeah. And incidentally, you and I have been talking about inflation, what the Fed is going to do, and how the Fed is going to react to this or that. And we've been talking pretty much the same conversation for now almost 3.5 years, pretty much since the pandemic. And recently I was at the Nasdaq Retail Executive
Mhm.
Summit, and I heard the Nasdaq economist, and he was pretty direct in saying that they felt like the Fed should have already cut rates, that they would have liked to have seen the Fed cut rates and be a little bit more proactive. And we know that traditionally the Fed is more reactive, meaning they tend to lag behind the data, like way behind the data.
I think,
Um,
well, like there's actually a couple of things here. I'm sorry, finish your thought, but then I
no,
have
no, that's
something.
exactly that was my thought.
So there's a couple things here. In fairness to the Fed, I think they're more politicized than they ever have been before, not by their choice, number one.
Yeah,
Number two, I don't think that how politics are being played, they necessarily understand the economic underworkings of how the system works. I mean, you'll hear legislators say things and they, Powell's on the Hill the past couple of days, and my head was spinning, right?
yeah,
So there's that. There is nobody on this planet who has a roadmap or a benchmark in terms of the pandemic that we had 100 years ago, where it correlates to what we're seeing now. So the environment that they're working in, it's not like they can compare it to what we saw in the 80s with interest rates and so forth. The underlying variables are very different. So not that, and then not making excuses, but someone like a Powell, his legacy is going to be on that one word, transient. You know what I
yes,
mean? Think of all the words that you and I say all day long. And I get it's his mandate, he's on the international stage for a reason, but it's not like we can say, oh, 10 years ago, this is how we managed COVID then,
yeah,
right? So this is new. We are laying out the roadmap.
yes, absolutely.
But if you look at it, the market, near all-time highs. I haven't looked at it in the past couple hours, but so
It's pulled back off those all-time highs, but I mean
right.
that's
But the whole
all
thing is, even if you're
right?
negative on the economy, if you are invested in your 401k, and that's, let's say everyone has the luxury of doing so, you're not in a bad spot.
Nope,
But again, the
absolutely.
economy is not the market, market's not the economy, your 401k is not indicative of what's coming in your pocket. But so that's why there's like this dichotomy of, well, we're all-time highs, but people feel bad about inflation.
Yes. Yeah, it's kind of a dichotomy going on. Let's
Yeah.
jump to our next item, which, basically could be the reason why the market just sold off is, you're at all-time highs and you're going into earnings season, and earnings brings with it a degree of volatility. So, what can we expect from the start of this month's earnings season? I mean, what are we expecting here?
So the strategies that we've had on our show, essentially echoing what you and I have always discussed, is that investors are more discerning than I think they ever were, because of the fallout we saw over the past couple of years with growth at all costs and throwing money, around whatever. So the concern is, and I'm using Micron and Nvidia as an example, I think the concern is with a stock like Nvidia, which has such influence on what's happening in the indexes in the market. What if you have a quarter like a Micron where you beat on every metric, but your guidance wasn't quite what the street had expected, right? And I think that is going to be the big, we always say that guidance is, the most important factor, but I think because of the run-ups that you've seen in a certain concentration in the market and just in general, it is going to be more important than ever. And I also think, from an existential perspective, we're really coming to terms with how we're seeing, pockets of leadership in the economy. So when you try and compare it to oh, is it like 99? Should we expect this blow up again? Well, Mike, if you take a look, basic pie chart of the S&P 500 as an example, what was more dominant then, right? Energy, the banks. Now, if you look at it now, technology is the overweight, and for a reason, because
Yeah.
that is how the economy has evolved. So to say the bubble is the same, it's different. We respect technology in a very different way. We cannot exist without it. And I just think the understanding is different than it was back then. So to say it's different this time, and I know everyone hates saying those type of things. Yes, will we get hiccups and volatility here and there? Yes, but it's not like we're going to shut the door on technology and there won't be some sort of recovery.
Yeah, I agree. I from what I've noticed, it was back in the tech bubble, right? In the internet tech bubble, technology was a sector. Now it's sectors within technology. It's like technology, it's like, okay, what sector is the hot sector inside of technology? Which brings me to my next point. Okay, what's the sector to watch? Is it EVs? Is it going to be semiconductors? It's like technology has broken into subsectors of technology. Is it internet security? Is it infrastructure, right? Like the market technology infrastructure stocks. Is it AI? Which sector is going to be the hot sector to focus on inside of technology, as opposed to which sector of the overall markets, right? Like it's
Right.
almost like technology has become that much of the pie that we have to break just the technology into its own pie chart.
Well, I mean, Mike, the whole thing is too, it doesn't have to be just about technology, right? If who's going to supply the materials and the construction, think like a Honeywell, a Caterpillar, to build these data centers, to build out the energy supply that we need to meet this demand? What about the
Yep.
utilities? I mean, there are other areas that are going to see operational efficiencies and growth because they're employing AI. Now, I get, look, as a portfolio manager, if you don't have these within your portfolio, it's just going to be a hard time to make your bench. I understand that this is an anomaly. It's not normal that you see companies move up trillions of dollars in market cap in such a short time. But to say that there is no other opportunity outside of technology, I mean, 2, 3 stocks is an anomaly, but being consistent and thinking longer term as an investor, I think there are opportunities there. But again, I'm a long-term investor, not a portfolio manager. I don't have to worry about
Yes.
making a benchmark.
Eh,
So
but you
it's
made a
tough.
great point, because what we're running into with with AI generating so much computer power, using so much computing power, we're going to need to completely overhaul the power grid network, right? Like there is a huge opportunity in supplying power, because the demand for power, like we're also having a heat wave, around pretty much
Mhm.
most of the country. So you have everybody using air conditioning. You have everybody using,
Right,
AI, which generates a huge amount of computer. You have people mining cryptocurrencies, which it takes a huge amount of energy. So the demand for energy is just so great compared to what it was in the past. So
right.
there are these infrastructure opportunities, because we're going to have to upgrade of all our infrastructure. Today, I was just taking a walk outside. I was looking, in the United States, you and I both travel abroad a lot. We have telephone poles and power lines outside of our houses above ground in the United States, except if you live in New York City or, one of the other major cities. You go to Europe, you don't see any telephone poles, above ground, right? Everything has been put underground. That's a huge upgrade in infrastructure. I mean, there's a lot of opportunities in infrastructure to supply the power, and obviously the way that we deliver the power in a more
Yeah.
stable and
But
structured
that's a
way.
longer term thing though, Mike. And I want to ask you a question, actually. Those are longer term. And again,
Yes.
public utilities and private partnerships and investments tend to move much quicker. So you have to factor in it's going to be longer term just because of the nature of the public private thing. But Mike, and I don't want to sound flippant here, but you know, as a trader, whether it's swing, intraday, day trading, and not thinking longer term, does it really matter though for you? If you see
Nope.
volatility in Nvidia or
Zero.
Tesla one day, I mean, you can make your year based on that. So does it matter for the purposes of, the people that
Not at
follow
all.
you as a day trader? You don't even have to know what the company does, but if the vol is there and there's,
I have
volume.
been done. I have been done by 11 to 12 o'clock every day for the last 23 years.
Mhm.
I have found that as a trader, the longer I stay in the market after the morning trade,
Yeah.
the more likely I am that I'm going to blow up my day. So,
Yeah.
I mean, part of the reason that I work with Dash Trader and other companies doing is just to keep myself busy and connected to the market, because trading is not related to anything fundamental. It's more related to just momentum and direction and whatever's in play, right? I mean, most of the times you want to trade the stocks that have the highest beta. And that brings me to the next. I've been watching Tesla rocket for the last 9 days, right? And then today it sold off a little bit, and probably it'll bounce up tomorrow. But again, why would you hold on to Tesla after it's been up 9 days? You got to take profit. If you're swing trading it, this has been the stock to trade in the last couple of days. And my question is whether or not maybe Tesla's became the new meme stock. I mean, it just seems like it's just been on fire lately. But again, you're right. As a trader, all I need to do is just focus on what's moving.
And that's why I wanted to bring it up, because I know, I'm on here talking longer term and more about fundamentals, but and that's why I wanted to be clear that, for your audience, that it's great to, talk fundamentals in the market, but at the end of the day, it doesn't even matter what they do, as long as you're in the momentum trade. Perhaps that's, what's best for people who are thinking, or, looking at technicals and other indicators that aren't so long term.
Yes, and it's hard to wear both hats, right? It's hard to
Right.
be the trader and the investor, right? So, when I'm doing any kind of investment, really my intention is kind of, it's very trader like. It's like, buy 10 shares, for a $5,000 investment, and once it turns to $10,000, take that 5,000 off the table and make the investment riskless, and then forget about it, right? I mean,
Yeah.
because I really, my skill set is more focused on the area of momentum, technicals, movement, and that stuff. I have no idea why Tesla's going up. I mean, to me, when I looked at the numbers, it looked like they had terrible delivery numbers, but 9 days afterwards, it's been like a rocket, so it is what it is. But that brings us to the next point of conversation. We heard all these predictions in Europe about the elections that were going to be swinging to the right in France, etc. And sure enough, I mean, it looked like all the pundits had it wrong. France and Europe seems to have continued to stay left to centrist. We have more political volatility in the United States, as I think it was Nancy Pelosi today urged Joe Biden to potentially make a decision whether he's going to drop out of the race or continue on. I'd love to hear your opinion as to that, how it would affect the markets potentially. But in general, will election drama cause market volatility this summer going into earnings season? Or maybe we should just kind of, what usually happens in the summer, which is basically doldrums, nothing, and then everybody comes back to reality in September. So
Well,
what are your thoughts?
it's interesting. I wish I understood UK and European dynamics better, politics and its dynamics better than I do. Admittedly, it's their structure's fundamentally different than ours, and I've tried to get it, but it's tough for me. But I will say, because of the interdependency, that as the EU knows it now, I think if they were to move towards more hard right isolationist policies, that could throw the trade balance, out of whack a bit. That that would be my first concern. And I don't, like I said, I don't know enough, for the micro part of that. But I
Yeah.
will say, and Mike, we've covered this before. In the past, elections have really not been bad news for the market, right?
No.
I think the bigger issues that we're facing here in the US are more social and ideological. You have to, the market did not, I mean, it did not react at all to the debate as as bad as it was for Biden. Let's call a spade a spade. Part of that is they know how Biden's administration functions. They know Trump and how his administration functions. I think we haven't heard much about policy, so it's really hard to discern what sectors are, going to move off of them or not. The biggest thing is if it's a split ticket, right?
Yeah.
If you're stuck and you can't get legislation or policy through, it's business as usual. If it moves to, all one side of, Democrat or Republican, that's where, it becomes a little bit more challenging, because you can start to get certain legislation through. If we're stuck, we're stuck. I mean, this has been the most ineffective Congress probably I mean, at least last century, right? So
Yes. I mean,
that's the big, the split ticket is the bigger deal.
yeah. I mean, my feeling is that, markets are forward looking. Okay. The
Yeah.
market was well aware that Joe Biden had some kind of mental situation. You and I have been, kind of, noticing it, for some time, that there's some kind of a mental situation going on there, that he's not fully there. And all the debate did was really broadcast that to the public, what the public already kind of knew. As for the European politics situation, I think Europe is just in a very different situation, which it's in a far worse economic situation than the United States is. And that is benefiting the United States, in a sense, making our market more attractive. And that is just being illustrated by the fact that, the U.S. market is, I mean, we're in a bull market. Right? I mean, whether we like it or not, because I think a lot of the, people like you and I who analyze the market and deal with the market every day, I'm skeptical of the bull market, but at the same time, a trend is a trend and the trend is up. So
Yeah.
go with it, right? I mean, that's what you got to do. I've learned that you don't predict the market, you follow the market. Okay. And that's the way that you stay in the right direction. So thank you very much for your insights as always, Jill.
Right.
Try to stay cool, and I'll see you in 2 weeks.
All right. Sounds good, Mike. Take care. Thank
Thank you
you.
so much, Jill. Great.
See ya.
Thank you. All right, let's jump to the charts here. All right, I'm going to maximize my first thing I'm going to look at here is I'm going to take a look at the QQQ, which is the Nasdaq 100 index. And I mean, you can see, I mean, a massive outside bar today. We pretty much, this would be called an outside bar, or it would be called a bearish engulfing bar. So a red bar that completely swallows up and engulfs the prior green bar is indicative of profit taking. Now, the fact that it came down and touched the rising 10-period moving average today, this Thursday, shows that the market is correcting extremely quickly. So, my guess will be that tomorrow we will have a little bit of a bounce, which would be indicative of a 1, 2, 3 continuation. If there is a secondary sell-off, then that secondary sell-off would probably take us back down to the 20 or the 10 or the 20 period moving average. Needless to say, that is the Nasdaq, which is, this is a market that, has already put in 1 rotation, 2 rotations, 3 rotations, and on the 4th rotation, rotation 1 through 3 is the most reliable. But then once you get to rotation 4, we call that the NV rotation, where everybody on the last pullback, everybody jumps in. People who missed the last move to the upside, everybody jumps in and rides it to the upside. We've been making record new highs basically since we broke out of the market high at 450 on the Nasdaq. Now we're going to take a look at the SPY. SPY is not quite as bearish, but remember, the Nasdaq has been leading the markets, whereas the S&P is kind of following the Nasdaq's lead. The S&P is what I would call bearish cloud cover, meaning that it's a rejection of a tweezer top. So this is a tweezer top, meaning that you've had to move up. And I would expect that at some point, maybe it would be bullish if we don't pull all the way back down to the 545 number. Probably if we pull back somewhere between 550 on the SPY, 550 to 552, that would be the area that we would put in a pullback. Anything above 545 is a bullish retracement, and we would expect a higher high. Now that doesn't, obviously we're going into earnings season. Anything can happen. Let's take a look at the first couple of stocks to announce. JP Morgan, I mean, basically looks like a bull pennant. But again, you can break out to the upside or the downside on earnings, whichever direction it goes. That's where it's, basically whichever way the earnings go. I would say that from a technical perspective, the initial move was up. You would expect the earnings to be positive and maybe a breakout to the upside. But again, that's all going to be down to the fundamentals. We can see that last earnings, we had basically a downside surprise, meaning the market did not do quite as good as we would have expected. There we go. We just got the market close on the Nasdaq, and we're going to take a look at a couple of other stocks that have been leading the markets. Let's take a look at Tesla. I mean, so here was what we were talking about with Tesla. Stock has been up for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days. It made a new high at 270 and then completely reversed and pulled back to its 10-period moving average. I'm going to look at Tesla, and then I'm going to look at NVIDIA. NVIDIA also having a massive pullback. Now on NVIDIA, it's a little bit more negative because we put in a high and then it failed to make a new high. Let's take a look at Tesla. Tesla is breaking out into high territory. So when we pull back on Tesla, I mean, this is really a new high for the year on Tesla. Whereas NVIDIA, when we put it on the weekly chart, this is looking like it's probably pulling back into its weekly rising moving averages. That does not mean that NVIDIA is going to reverse and sell off completely, but it looks like it's heading back into its buy zone between the 10 and the 20 period moving average, which is 115 to 102. So we got that little buy zone area here, right, between 102 and 115. And then, of course, we could potentially look for another move to the upside, after it consolidates for a bit. So that's all going to be contingent on things like earnings. Let's take a look at Microsoft, MSFT. Okay, Microsoft definitely pulling back quite considerably the last couple of days. It's already been pulling back for 4 days. Again, Microsoft is one of the technology companies that announces early. AAPL, another key technology company, did not really have a terrible bad day today. We have, Apple getting all the way up to 232, but pulling back to 227 recently. So certainly Apple holding up pretty well. Let's take a look at Google. Google selling off again, pulling back into the 10-period moving average. But all these are pullbacks in uptrends. These are not stocks that are completely reversing. Last but not least, let's take a look at oil. Let's see, USO. USO oil is on the rise, right? So we know that the OPEC countries have cut back supply. We are in the summer months. Their oil usage is up, so there's increased demand. And oil is coming up to a possible breakout point. So if oil breaks out above 83.50 on the USO, then that would be a breakout to new highs. And that would be very negative for inflation, meaning that inflation, oil is the prime commodity. Inflation should move to the upside if oil continues to go up above $84 a share on the USO. It doesn't necessarily equate to the per barrel. Last but not least, GBTC, which is the tracking stock for Bitcoin. We're looking like we're at the buy area of a bull flag on Bitcoin and cryptocurrency, meaning cryptocurrency has been pulling back. It's kind of pulled back to its prior support area. And that makes sense post halving. So you could see that this is the first green bar on the weekly chart on Bitcoin GBTC tracking fund on cryptocurrency. So possibly this is a point that cryptocurrencies might reverse and go higher. Last but not least, we're going to take a look at the GLD, which is the old man, gold. Gold is at really breakout points. I mean, gold is right back at the prior high. Gold is at 223 on the GLD ETF tracking stock of gold. We know that that obviously a breakout would be a breakout above 226, and we see where we go from there. Needless to say, the old man gold is been doing pretty well. Now that makes sense because we're in a very inflationary environment. U.S. dollar is strong, but if the U.S. dollar starts to weaken, gold is the inverse to the U.S. dollar. That's why we call it the old man. Before the U.S. dollar was the prime currency, gold is the traditional backer of all currencies. So that's why gold is showing signs of strength. So all of this makes sense from a fundamental perspective. All right. On that note, I'm going to wrap things up. We just finished our market analysis section, and I'd like to invite you to all stay up to date with all things DAS by signing up to our monthly newsletter. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel at Dash Trader TV for the Dash Trader Newsroom reminders. I really suggest that anybody who's seeing this for the first time, make sure that you join us in 2 weeks. We're going to be doing more and very different topics here in the newsroom. And you should certainly follow us on social media, LinkedIn, Twitter, Facebook, and Instagram. Great content on all of those venues. Thank you so much for joining us. See you next time. Trade well.